The March quarter earnings saw sequential improvement as some previously battered sectors like metal, oil and gas, and auto saw profit recovery. The number of companies that beat estimates also exceeded those who posted a negative surprise for the first time since September 2021. The overall net profit rose over 10% year-on-year to notch a record high of nearly 3 trillion rupees, primarily driven by BFSI companies, while the profits of non-BFSI firms fell 4.6% from last year on muted revenues and higher operating and interest costs. Analysts expect the FY24 earnings to lag consensus estimates as India Inc. will see more earnings downgrades, especially in pockets like IT and metals, which remain adversely impacted from a global economic slowdown.
Any export-oriented sectors in India, like the IT sector especially, will see an impact, right? So you will see downgrades happening in the IT sector maybe in the next couple of quarters. Similarly, your metal sector, which depends a lot on global growth and demand coming from China and the US, will also see downgrades. That we can pivot our portfolios to stay a little bit safe from external linked sectors until unless the situation in the US clears up, right? They're facing a debt ceiling and they're seeing a growth slowdown, and they might in fact see a recession coming in. So we could stay away from sectors that are export oriented or are dependent on the external economy, and we can focus on maybe infrastructure linked sectors in India.
In a note last month, Amish Shah of Bank of America said that Nifty consensus estimates are lofty despite a weak outlook for software firms and could be slashed to 11% and 9% for FY24 and FY25, from 17% and 16% respectively. As against the consensus Nifty EPS estimate of 991 rupees for FY24, Ambit Capital and Kotak Institutional Equities see this as 940 rupees and 913 rupees respectively. Meanwhile, banks, NBFCs are key sectors that will likely stem the weakness in overall earnings ahead, analysts say.
So I think banking and finance, that is NBFCs, this sector should continue to support. It has already supported for the last couple of quarters, and it continue to support because credit demand is very strong. If you go by the verbatim given by various public sector as well as private sector banks, I think if rains do not play a havoc, FMCG should also contribute, and along with that, consumer discretionary like autos, this should do well.
Analysts suggest investors stay away from select pockets like IT and instead raise bets to high beta players like banks. Today, on June 2, equity markets will seek direction from global markets. The crucial jobs data for May will also be eyed in the US.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.